In private fund operations, Treasury is often viewed as a back office function, responsible for moving money, managing wires, and ensuring cash is where it needs to be. But this narrow view misses the strategic, risk-sensitive, and increasingly tech-enabled nature of Treasury's role in modern fund administration. Treasury as a strategic function, at its core, Treasury in a private fund is responsible for cash flow orchestration. This includes capital calls and distributions, ensuring timely, accurate execution and communication, banking relationships, managing accounts across jurisdictions, currencies, and counterparties, liquidity management, forecasting cash needs across entities and vintages, FX and interest rate exposure, mitigating risks in multi-currency structures or when using capital call lines. But beyond these mechanics, Treasury plays a strategic role in fund pacing, investor experience, and risk management. For example, a well-timed capital call can reduce idle cash drag for LPs, while a poorly timed one can create friction or reputational risk. Treasury touchpoints. Across the fund lifecycle, Treasury interacts with nearly every phase of the fund lifecycle: fundraising, setting up bank accounts, onboarding investors, and preparing for initial capital calls; deployment, coordinating wires for investments, managing escrow, and ensuring compliance with AML/KYC; operations, handling recurring payments, FX conversions, and intercompany transfers; exits and distributions, executing waterfall payments, calculating holdbacks, and managing tax withholdings. Each of these touchpoints requires coordination with legal, tax, accounting, and investor relations teams, making Treasury a cross-functional hub. Common challenges and controls: Treasury teams face a range of operational and compliance challenges: banking complexity, managing dozens of accounts across multiple banks and jurisdictions; fraud risk, wire fraud, and phishing attacks are real threats. Treasury must implement multi-layered controls; timing mismatches, investment closings and capital calls don't always align perfectly, requiring bridge financing or careful cash management. Audit trail, Treasury must maintain detailed records for auditors, regulators, and internal stakeholders. Strong Treasury controls include dual approvals, segregation of duties, automated workflows, and real-time visibility into cash positions. AI in Treasury. Practical, not hype artificial intelligence is beginning to reshape Treasury workflows, not with flashy dashboards, but with quiet automation and predictive insights. Examples include cash forecasting models that learn from historical patterns and upcoming deal activity; anomaly detection in wire instructions or payment approvals; natural language processing to extract payment details from emails or documents; automated reconciliation between bank statements and fund accounting systems. These tools don't replace Treasury professionals, they augment them, reducing manual work and surfacing risks earlier. Final thoughts: Treasury in a private fund is more than a money-moving function. It's a strategic, risk-sensitive, and increasingly tech-enabled discipline that touches every corner of fund operations. As funds grow more complex and investor expectations rise, Treasury's role will only become more central.